Hello everyone, and welcome to my channel. Buffett has often emphasized that, for ordinary investors, it's better to simply hold an S&P 500 ETF rather than research individual stocks. It's hassle-free and more likely to deliver steady returns. However, there are many different S&P 500 ETFs on the market. Some simply track the index, while others focus on balance, growth, dividends, and other factors. In today's video, we will provide an in-depth overview and side-by-side comparison of these mainstream S&P 500 ETFs, helping you choose the one that best fits your investment strategy from multiple angles. If this is your first time finding my channel, don't forget to click the subscribe button below so you can watch my videos as soon as they're released. Without further ado, let's get started. Currently, the four main ETFs tracking the S&P 500 in the market are SPY, VO, IVV, and SPLG. You'll notice that these funds are all issued by industry giants, but eagle-eyed viewers may have spotted that both SPY and SPLG are issued by State Street Global Advisors. Why would they issue two separate S&P 500 ETFs? I'll leave you in suspense and reveal the answer later. From an inception date perspective, SPY was the first, but even the newest one, VOO, has been around for 15 years. That means all four ETFs have plenty of historical data to reference, so there's not much difference in that respect. As for fund structure, aside from SPY being a unit investment trust, the other three are exchange-traded funds. What's the difference? With a UIT, in special periods, such as when index components are rebalanced, the fund must sell stocks for cash internally. That process generates capital gains inside the fund and distributes them to all holders, which means even if you don't sell your shares, you still owe capital gains tax on those invisible sales. But ETF structure could avoid this invisible sale. You only trigger capital gains tax when you personally sell your shares on the market. For long-term holders, this greatly reduces the chance of being dragged down by taxes, allowing your returns to compound more smoothly. From a tax perspective, that makes SPY less advantageous than the other three. Next, let's look at management fees. Although all four funds have relatively low fees, SPY's fee is the highest and SPLG's is the lowest. The difference is only about 0.07%. But over the long term with compounding, that gap can translate into a 2 to 3% difference in returns. So, if you're a long-term investor, choosing the ETF with the lowest fee clearly makes more sense. So far, you may have noticed that SPY falls short on tax efficiency and cost. But what's its advantage? Here it is, liquidity. SPY is one of the most actively traded ETFs in the world, with average daily volume far exceeding the others. If you prefer short-term trading, SPY is undoubtedly the best choice. No matter how volatile the market, it almost always offers ample liquidity. That's one reason institutions and traders continue to favor it. Even so, because of its higher fees and tax drawbacks, SPY's market share has gradually declined in recent years. This year, VO even overtook SPY in fund size, knocking SPY off the top spot among S&P 500 ETFs. Once a fund size is surpassed, it's only a matter of time before its trading volume is overtaken too. State Street recognized this, which is why in 2017, they restructured SPLG, switching it from tracking the Russell 1000 to tracking the S&P 500 and cutting its fee to 0.02% to directly compete with VOO and IVV, aiming to attract long-term investors. Finally, let's examine dividends and performance. Since they all track the same index, their returns are almost identical. Dividend yields hover around 1.2%, and the 5-year annualized total return is about 16.6%. To summarize, if you're a short-term trader who values liquidity, choose SPY. If you're a long-term investor seeking the lowest cost, go with SPLG. And if you want a balance of liquidity and cost, VOO or IVEV are solid picks. Now that we've covered these four standard S&P 500 ETFs, let's look at some theme-focused S&P 500 ETFs. These also use the S&P 500 as a base, but apply different stock selection or weighting strategies, so their performance can diverge from traditional ETFs in various market environments, offering more diversification options. First up is RSP. RSP is a classic strategic S&P 500 ETF. Unlike SPY and VO, RSP weights every component equally rather than by market cap. In the traditional S&P 500, giants like Apple and Microsoft might each account for 6 to 7% of the fund. But in RSP, every company, large or small, has roughly a 0.2% weight. What's the benefit? Equal weighting reduces the impact of any one megacap on index swings and gives more exposure to mid and small caps and value factors that can help RSP outperform in certain environments, like early economic recoveries or bull markets, but also incurs higher rebalancing costs each quarter. RSP's fee is 0.2%, noticeably higher than the traditional ETFs. Next is SPYG, another State Street product. Here the G stand for growth. SPYG includes only the S&P 500 stocks that meet growth criteria, companies with high revenue or profit growth. Its 5-year annualized return is about 17.08%, slightly above the traditional ETFs. But because of its stricter selection, SPYG holds only 212 stocks, with the top 10 accounting for over 50% of its weight. That concentration increases risk and volatility, so SPYG can fall more sharply during value rotations or market pullbacks. Finally, there's SPYD, SPYG's dividend-focused sibling from State Street. SPYD picks roughly 80 S&P 500 stocks with the highest dividend yields, giving it a yield of about 4.43%, far above the other ETFs. If you want stable cash flow, SPYD is ideal. But by excluding some high-growth, low-yield names, SPYD will lag other ETFs in rising markets. I've displayed the key data for these 3 specialty ETFs alongside the 4 traditional ones for easy comparison. You can pick the ETF that best matches your goals. But be aware that all 7 ETFs hold S&P 500 stocks, so combining them can lead to significant overlap. You should pay closer attention to avoiding overconcentration in the same assets. A common portfolio strategy involves primarily holding a core large-cap ETF like VOO, while allocating a portion to a factor-based ETF. For example, using a 70% VOO plus 30% SPYG allocation can increase exposure to the growth factor. However, it's important to note that SPYG and VOO have a high holdings overlap of up to 67%, which can lead to overconcentration in the same stocks, increasing overall volatility and risk. In contrast, pairing SPYD with VOO results in only about 7% overlap, which not only significantly boosts dividend yield, but also effectively avoids excessive overlap and reduces concentration risk. ETFs are a fantastic tool for beginner investors, offering powerful functionality and many strategies. Only by using them correctly and thoughtfully can you achieve better results with less effort. So, I'm planning a dedicated ETF series, diving into common ETFs and showing how retail investors can build and adjust ETF portfolios under different market conditions. If you're interested, subscribe to my channel and hit the bell so you'll catch every new video as soon as it's out. That's it for today's video. If you found this helpful, please like and share these insights with your family and friends. I'm Ryan. See you in the next video.